My name is Matthew Sheridan, Chief Investment Officer here at TFO. Look, the headlines can be hard to ignore sometimes. It's almost impossible to pick up your phone these days without reading headlines on potential recessions, tariffs, geopolitical conflicts. But what we do know is that is rarely the full story. What I'd like to do today is present 4 charts that I believe are foundational to successful investing today. My goal really is to provide a digestible video to provide you all with perspective to help you look through some of these headlines. First headline you're most likely seeing is we're about to head into a recession. That is totally normal, and it is very common for us to actually run into recessions. What we're showing here is an economic chart going back pretty far in history, about 170 years. And what you'll see is in the green shaded bars are recessionary periods. We've had 35 of them since the mid 1800s. Each one felt different, but they all have eventually passed, as you can see on the chart. They happen about once in every 5 years. It is natural to think you can avoid these, but that's really impossible. What we suggest here at TFO is enduring them. It's part of the deal of long-term investing. Our economy grows, it evolves, we transition as an economy, and it is just quite normal to experience a recession on an ongoing period. Now, another headline we are probably seeing right now, we're about to head into a bear market. Again, very common. What you can see in this visual is you are virtually guaranteed that the longer that you invest in the stock market, the more likely you are to actually experience a bear market. You can see these green bars signifying those odds going back since 1950 increase consistently the longer you invest. So going back to 1950, if you were to invest in any 1-year period, your odds of experiencing a meaningful drawdown in the equity market are about 32% over a 1-year period. But if you move forward and you look 10 years, 15 years, it is almost a near certainty that you will experience a large fall in equity prices. This is not a flaw of the equity markets. This is only natural. You cannot remove this risk. You cannot change it, but you can plan for it. You can diversify into new and different markets. You can bucket assets in a way to plan for these inevitable drawdowns in equity markets to provide liquidity and optionality when these do in fact occur. But you can't avoid them, and they will continue to happen. And if you look out further down the road, you're almost guaranteeing that they will happen. Another headline that I'm sure you all are seeing, things seem a little bit more heightened than they have been in the past. And what we're looking at right here is actually one of my favorite types of visuals that really proves out, historically speaking, that average returns in the stock market are extremely rare. So again, using a 1950 starting point here for these visuals, we're charting out what the calendar year returns look like for the S&P 500, so the U.S. equity market. On the left-hand side are calendar year returns with the highest return. On the right-hand side, what you'll see is the calendar years with the worst return. And what you'll clearly see here, highlighted in the light green, is that years where you get an average return in the equity market, which is pretty widely quoted as between 5 and 10% a year is what you hear, has only happened 6 times in the last 75 years, so less than 10% of the time. What is actually more normal and more common is that you experience meaningfully higher up years or somewhat painful down years. So if you were to look at the averages of all those bars to the left, so those really, really good years in the market, the average up year is up about 18%. Do the same thing for down years. The average down year is down about 12%. This helps explain why staying invested is so difficult. It feels hard because it is. You're in a constant battle between greed and fear. And this is a fact of investing in the equity market, is that it does not align with typically average years. So last but not least, get out now, get back in when it feels better. That's what you most likely are hearing when you pick up your phone, you look at social media, you watch the news. There's a better way to invest, and it's waiting for the dust to settle. So what we're looking at here is a chart that shows two different hypothetical portfolios. The dark green line shows if you stayed fully invested in the U.S. equity market, and the light green line shows what would have happened if you missed just one day, which was April 9th. Now you might be thinking, how would you just miss one day, which is April 9th? Well, on April 8th is when we really reached fever pitch in the U.S. news cycle in terms of how concerned folks were with the tariffs that were announced a week prior. So if you left the equity market on the 8th, you tap out. It's not something you can withstand anymore. April 9th, you wake up. The administration announced a pause on tariffs. You get back in on April 10th. So you just miss one day. You can see that you can wipe out your returns for the entire year. Statistically speaking, your largest down days are often followed by your largest up days. So if you incorporate a strategy where you attempt to miss the big down days, you are signing up to also miss the rebounds and the big up days, which can be the difference sometimes of having a successful versus an unsuccessful year investing in the equity market. This is why we at TFO emphasize discipline, and we are advocates against trying to time the market. In closing, staying the course isn't easy, but it does work. Thank you for watching.